Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Here are the interest rate rules, and again, if there's anything to take away from this bit of a nebulous webinar today, I think these are some solid rules that I think are worthwhile spending the time here, at least when we get to this. And this comes from John Percival. John Percival has been trading currencies since the early 80s. He's from London, editor of the Currency Bulletin. Just a kind of guy that knows more about currencies than, forgotten more than most people would ever know. And I think I've learned a lot by just reading Percival over the years. And he gives these very interesting interest rate rules that I think if you understand these in and of themselves, it'll help you as a currency trader, at least in the intermediate term time frames, which I think ultimately is the meat of where you make money in currencies. Interest rate shifts, number one, interest rate shifts that are prompted domestically tend to lead a currency. What does that mean? It means that if your economy is heating up and your central bank has to raise interest rates and because of its concern about an overheating economy, too much money pouring in, concerned about future prices going higher, they tend to lead the currency. When the pressure is domestically, whether it's a cut in interest rates, domestically because of significant fall off in growth, or it's a hike in interest rates because of significant overheating, those are the interest rate moves that tend to lead currencies. Interest rate shifts prompted internationally tend to follow and move in the opposite direction. What does that mean? It means that if a country is under attack by speculators because of some things that are going wrong, too much inflation, for example, you're going to see it pretty quickly in a movement in the currency. Then you're going to see that central banks hike interest rates in order to protect the currency. So it lags. And then that hike in interest rate is an indication that the central bank is trying to defend the currency. So you, again, tend to see people fight against that and the currency continue to move in the opposite direction. But think about rule number two. And back to what we talked about before, of stabilization. Okay? Perception of stabilization, all right? Back at this chart, we apply that second rule to the second rule here. The country has hiked interest rates fairly dramatically, 2, 3, 4, 5% to protect the currency. When you want, at the point at which that yield differential starts to bite and then starts to become powerful for the currency is when the currency finally stabilizes, okay? When the currency stabilizes and they've raised rates significantly to protect the currency, then you usually see the currency start to move back the other way. All right, and this is usually measured in months. So this is something, again, to keep in mind as we watch some of these, some of these players out there. Again, most of the majors haven't recently, over the last several years, the central banks haven't had to hike interest rates in order to protect their currency. You tend to see this in some of the minor currencies in the world and obviously some of the emerging markets in the world, but it's a good rule to keep in mind. Look for stabilization. Once the yield is significant, again, this is measured in months, you're then usually going to see the currency follow and rise fairly sharply. And what's going to happen is people that get too hung up on this idea that interest rates falling mean the currency is going lower are going to miss this type of move right here, because ultimately once the currency stabilizes, once the country has made its big interest rate move to protect the country because of international pressures, as things start to normalize, interest rates are going to come down, and people say, well, the interest rates are falling again, we shouldn't buy the currency, but the reality is more money is going to flow into the country on the economic growth side and be that powerful foreign direct investment driver for the currency. And of course, a currency is led by interest rates when the move is unexpected. And that's when we get back to the point, if everybody in the market is expecting the Fed to be on hold, and all of a sudden we wake up one day and the Fed hikes rates 1%, totally unexpected, that's the stuff that moves currencies. But again, it's not the stuff we can forecast. But it's the stuff of reality that moves it. Sentiment, the Tao of the markets. The reality is more markets seem the most bullish. They're really the most risky or the most bearish, and it really is the way it has to be. And we see this in all time frames in the currency markets. What can we look at in terms of sentiment to try and get a handle on sentiment? There's really three things, I guess, that we use. One is open interest. When we look at open interest on the Chicago Mercantile Exchange of all the major currencies, and you tend to see high open interest moving in line with a pretty powerful trend. And the reality is when trends start to change, you see an extreme in open interest, a historical stream in open interest. The reason you see that is there's really two types of players in the currency market. There's the value-led currency traders and there's the price-led currency traders. When you see an open interest extremes, it means the value-led traders and the price-led traders are all on the same page, and there's really very few people left to buy. That's when you get that sentiment extremes, and that's a setup condition that you're watching. Volatility. We watch volatility. You can use the VIX. You can use options volatility for this. Obviously, low volatility just assumes that the trend's intact, and you have a lot of complacency out there in the world. This is it tends to be a valuation measure. Low volatility, everything's going to be okay. I'm going to stay with this trend, continue to push money to the trend. There's where the idea that when people get complacent, a surprise is the biggest mover here. Reaction to the news and consensus. When price action doesn't confirm the consensus, it should get your attention. Old hands on Wall Street many years ago used this, and they still do today. When a new piece of news comes out and the price reacts differently than it should based on the consensus view, it's a very powerful indicator. And this is the idea of sentiment and setup conditions. So this is what helps you determine those expectations that are in the markets about currencies.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.